In the early hours of January 3rd, the global order was shaken by an event few believed would ever unfold so directly. The United States launched a swift military operation in Caracas, capturing Venezuela's sitting president, Nicolás Maduro. Within hours, headlines focused not only on sovereignty, legality, and geopolitics, but on oil.
The first wave, if you'd like to call it that, the first attack was so successful, we probably don't have to do a second, but we're prepared to do a second wave, a much bigger wave, actually. Probably won't have to do.
Venezuela holds the world's largest proven crude reserves, and any disruption inside its borders instantly raises fears of energy shocks, price spikes, and global instability. Yet beneath the dramatic optics lies a deeper question. Does Venezuela still matter to the global oil market the way it once did? Venezuela's oil power, myth versus reality. For decades, Venezuela's name has been synonymous with oil wealth. With an estimated 303 billion barrels in proven reserves, the country officially holds nearly 1/5 of all known crude oil on Earth. On paper, this makes Venezuela an energy superpower, capable of shaping prices, influencing alliances, and destabilizing markets with even minor supply disruptions. That perception alone is enough to send traders into panic whenever Caracas appears in the news. But markets do not trade on reserves. They trade on barrels actually delivered. At the time of President Maduro's arrest, Venezuela was producing roughly 1 million barrels of oil per day, less than 1/3 of what it pumped at its peak in the late 1990s and early 2000s. In a global system producing over 100 million barrels per day, Venezuela now accounts for less than 1% of total supply. This is the uncomfortable reality confronting traders as futures markets prepare to reopen. Venezuela's oil power has become more symbolic than structural. This decline did not happen overnight. Years of political intervention in the state oil company PDVSA, chronic underinvestment, corruption, mismanagement, and international sanctions steadily hollowed out what was once one of the most technically sophisticated oil industries in the developing world. Equipment rusted, skilled engineers fled the country, refineries shut down or operated at a fraction of capacity. Even when oil prices surged globally, Venezuela lacked the ability to respond. As a result, the immediate fear that Maduro's removal would trigger a global oil shock has been tempered by cold arithmetic. Even in a worst-case scenario, where Venezuelan exports collapse entirely, the global system has room to absorb the loss. OPEC members, particularly Saudi Arabia and the United Arab Emirates, maintain spare capacity. U.S. shale producers remain flexible, capable of ramping output when prices rise. Russia, despite sanctions, continues exporting at scale. The oil market of 2026 is not the oil market of 1973. That context explains why analysts expect, at most, a short-lived psychological spike in prices. Traders may bid crude higher in the first sessions following the arrest, reacting to uncertainty rather than fundamentals. But history suggests those gains will fade quickly once data confirms that physical supply remains largely unchanged. Recent precedent reinforces this view. Just weeks earlier, U.S. authorities seized shipments of Venezuelan crude at sea, briefly pushing West Texas intermediate prices above $60 per barrel. The move sparked headlines but not sustained momentum. Prices soon retreated toward the mid-$50 range as traders refocused on a far larger problem: global oversupply. That oversupply is the dominant force shaping oil markets today. OPEC has struggled to balance discipline with revenue needs. Demand growth remains sluggish amid economic uncertainty, high interest rates, and slowing industrial output across major economies. Even without Venezuelan barrels, the system is awash in crude. Yet dismissing Venezuela entirely would be a mistake, because while its current output is small, its latent potential remains enormous. Venezuela's heavy crude reserves, difficult, sulfur-rich, and expensive to process, require advanced technology and massive capital investment. For years, sanctions and political risk kept international oil majors away. But with Maduro removed and Washington openly signaling support for Western energy companies to return, the long-term equation may be shifting. If U.S. and allied firms regain access, rebuild infrastructure, and stabilize production, Venezuela could eventually add millions of barrels back to global supply. Not tomorrow, not next month. but over several years, enough to reshape long-term price expectations. Ironically, that possibility creates a different kind of pressure on markets. Not fear of shortage, but fear of abundance. Investors are beginning to ask whether a post-Maduro Venezuela could accelerate an already looming surplus, pushing prices lower for longer and forcing OPEC into yet another painful round of production cuts. In that sense, the arrest of a president may matter less than what comes after, the reopening of one of the world's largest oil frontiers. And that is where uncertainty truly begins. Market shock without a shock. Why oil prices stayed calm. When news broke of Nicolás Maduro's arrest, many expected chaos to ripple through global markets. Historically, the removal of a leader in a major oil-producing nation has triggered sharp price spikes, panic buying, and emergency meetings in trading rooms from New York to Singapore. The images coming out of Caracas, military convoys, secured government buildings, and a sudden power vacuum seemed like the textbook trigger for an energy shock. But as trading desks digested the information, something unusual happened. Calm prevailed. The reason lies in how dramatically the global oil market has changed over the past 2 decades. In earlier eras, even the hint of supply disruption in a major producer could send prices soaring. Today, traders look beyond headlines and focus on spare capacity, inventories, and demand curves. In that calculus, Venezuela no longer occupies the central role it once did. At the time of the arrest, global oil inventories were already elevated. Strategic petroleum reserves in the United States remained well-stocked. Commercial storage levels in Europe were stable, and Asian buyers had diversified supply chains built after years of geopolitical shocks. The system was prepared, not for Venezuela specifically, but for instability in general. More importantly, the market is currently dominated by a structural imbalance. Supply is running ahead of demand. Economic growth across key consuming regions has slowed. Manufacturing indicators remain weak in Europe. China's post-pandemic recovery has underwhelmed expectations. Even in the United States, fuel demand growth has softened as efficiency improves and electric vehicle adoption accelerates. Against that backdrop, the loss of Venezuelan barrels, if it even occurs, looks marginal. That reality explains why analysts expect only a brief psychological reaction. Initial trading sessions may see prices edge higher as algorithms and short-term speculators respond to uncertainty. But without confirmation of real sustained supply losses, those moves are likely to reverse. In oil markets, emotion fades quickly when fundamentals fail to support it. This dynamic highlights a broader truth about modern energy markets. Geopolitics alone is no longer enough. Wars, sanctions, and regime changes matter, but only when they materially alter flows. In recent years, even major conflicts have struggled to produce lasting price shocks unless they directly removed large volumes from circulation. Yet the calm should not be mistaken for indifference. Behind the scenes, energy companies, governments, and investors are reassessing their long-term positions. The arrest of Maduro raises critical questions about legitimacy, sanctions, and access. If a new government emerges that is recognized by Washington and its allies, sanctions could be lifted or eased. Contracts frozen for years might be renegotiated. Projects once deemed untouchable could suddenly move forward. For oil markets, this creates a paradox. In the short term, nothing changes. In the long term, everything might. If Venezuela reopens to foreign capital, production would not surge overnight. Infrastructure damage is extensive. Refineries require years of repair. Pipelines need modernization. Human capital, engineers, geologists, technicians must be rebuilt after years of emigration. But markets are forward-looking. The mere expectation of future supply can shape prices today. That expectation adds pressure to OPEC and its partners, who are already struggling to manage excess capacity. Every credible signal that millions of additional barrels could return in the coming years undermines efforts to keep prices elevated. For producers dependent on oil revenue to balance budgets, this is a serious concern. Meanwhile, consumers in importing nations see opportunity. Cheaper energy reduces inflationary pressure, lowers transportation costs, and provides breathing room for fragile economies. From this perspective, Venezuela's potential return is not a threat, but a relief. The arrest of Maduro, then, has not shocked the oil market. It has reframed it. The focus has shifted away from fear of disruption and toward anticipation of surplus. Traders are no longer asking, what if Venezuelan oil disappears? They are asking, what if it comes back? And that question carries consequences far beyond Caracas. Inside Venezuela, economic collapse, social fallout, and the human cost. While global markets debate supply curves and price stability, inside Venezuela, the arrest of Nicolás Maduro marks a moment of profound uncertainty for a population already pushed to its limits. For ordinary Venezuelans, oil is not an abstract commodity traded on screens. It is the backbone of the national economy, the source of public services, and for decades, the promise of social mobility. The collapse of the oil sector has been inseparable from the collapse of daily life. At its height, Venezuela produced more than 3.5 million barrels of oil per day. Oil revenues funded subsidies, healthcare, education, and food programs that defined the social contract of the Chavez and early Maduro years. When production fell and export revenues dried up, that contract unraveled. Hyperinflation wiped out savings. Public salaries became meaningless. Millions left the country in one of the largest migration crises in modern Latin American history. By the time of Maduro's arrest, Venezuela's economy was a shadow of its former self. Oil infrastructure lay in decay. Power outages were routine. Water shortages plagued major cities. Hospitals lacked basic supplies. For many citizens, the question was not who controlled the presidency, but whether any stability might finally return. The immediate aftermath of the arrest has generated both hope and fear. Hope that a transition could unlock foreign investment, restore oil output, and stabilize the currency. Fear that power struggles, internal conflict, or mismanagement could push the country deeper into chaos. History offers Venezuelans few reasons for blind optimism. Oil workers sit at the center of this uncertainty. PDVSA's workforce, once among the most skilled in the global industry, has been depleted by layoffs, political purges, and mass immigration. Those who remain face dangerous working conditions, unreliable pay, and outdated equipment. A reopening of the sector could mean jobs, training, and safer operations, but only if governance improves and investment follows through. Socially, the stakes extend beyond economics. Oil revenue has long shaped Venezuela's political culture, reinforcing centralized power and patronage networks. Any attempt to rebuild the industry raises questions about transparency, corruption, and control. Will oil wealth once again flow to public services, or will it be captured by new elites? Will communities near oil fields see environmental safeguards restored, or will extraction accelerate without oversight? International stakeholders are watching closely. Neighboring countries, already hosting millions of Venezuelan migrants, have a vested interest in stability. A recovering Venezuelan economy could slow migration flows and ease regional pressure. Conversely, renewed unrest could trigger another wave of displacement. For the United States and its allies, the social dimension matters as much as the barrels. A peaceful transition that improves living conditions strengthens the legitimacy of engagement. A chaotic one undermines it and risks turning Venezuela into a prolonged flashpoint. In this sense, oil is both a solution and a risk. Reviving production could generate revenue and restore state capacity, but if mismanaged, it could deepen inequality, fuel conflict, and entrench new forms of instability. As markets remain calm, the human consequences are anything but. For Venezuelans, the arrest of Maduro is not measured in cents per barrel, but in the fragile hope that years of decline might finally give way to recovery, or that another chapter of uncertainty is about to begin. Global stakeholders, winners, losers, and the strategic recalculation. Beyond Venezuela's borders, the arrest of Nicolás Maduro has triggered a quiet but significant reassessment among global stakeholders whose interests intersect with oil, power, and geopolitics. While markets have not panicked, governments and corporations are recalculating strategies shaped by years of sanctions, isolation, and constrained access to one of the world's largest untapped energy reserves. For the United States, the event represents both validation and opportunity. Washington has long argued that Venezuela's economic collapse stemmed from authoritarian governance and mismanagement, rather than external pressure alone. With Maduro removed and U.S. officials signaling that military operations have concluded, the focus shifts from coercion to reconstruction. American oil companies, many of which operated in Venezuela decades ago, are now positioned as potential partners in rebuilding the sector. Access to Venezuelan heavy crude also carries strategic value for U.S. refiners designed to process such grades, reducing reliance on other politically sensitive suppliers. For OPEC and its partners, the implications are more troubling. Venezuela has technically remained an OPEC member throughout its decline, but its production collapse made it largely irrelevant to quota negotiations. A revived Venezuela would complicate an already fragile balancing act. Every additional barrel brought back online increases pressure on the cartel to either cut elsewhere or accept lower prices. Internal divisions within OPEC, between those seeking revenue and those prioritizing price stability, could intensify as Venezuela's potential reemergence looms. China and Russia, both of which deepened ties with Caracas during years of Western sanctions, face a more uncertain outlook. Beijing extended billions of dollars in oil-backed loans, while Moscow invested in energy projects and political support. A political transition aligned more closely with Washington could dilute their influence or force renegotiation of existing agreements. For these powers, Venezuela has been both a strategic partner and a hedge against U.S. dominance. That hedge may now be weakening. Energy importing nations, particularly in Europe and Asia, see potential upside. Additional supply entering global markets could ease price volatility and reduce inflationary pressure at a time when many economies remain fragile. For policymakers struggling with energy costs and public discontent, Venezuela's long-term return represents a stabilizing factor rather than a threat. Yet these benefits depend on a crucial assumption that political transition leads to institutional reform. Investors remain wary. Venezuela's history of expropriation, contract disputes, and abrupt policy shifts has left deep scars. Capital will not flow simply because sanctions ease. It will require legal clarity, credible governance, and security guarantees. Environmental stakeholders also enter the equation. Reviving heavy crude production raises concerns about emissions, ecological damage, and climate commitments. International oil majors, under pressure from shareholders and regulators, must balance opportunity against reputational risk. For them, Venezuela is not just an energy project. It is a test case for operating in high-risk, high-reward environments under global scrutiny. In aggregate, the arrest of Maduro has not redrawn the oil map overnight. Instead, it has reopened a map that had been frozen. Alliances may shift, contracts may change, and strategies will evolve, but slowly, cautiously, and with competing interests pulling in opposite directions. The true impact will be measured not in immediate market moves, but in the alignment or collision of these global stakeholders as Venezuela's future unfolds. Long-term outlook, oil abundance, energy transition, and a changed global equation. As the immediate shock of Nicolás Maduro's arrest fades, attention turns to what this moment could mean over the next decade, rather than the next trading session. The long-term implications for the oil market are not defined by disruption, but by potential reintegration of Venezuela into a system already struggling with excess supply and an accelerating energy transition. If Venezuela succeeds in stabilizing politically and reopening to foreign investment, production could gradually recover from its current lows. Analysts caution that this would be a slow process. Years of neglect cannot be reversed quickly. Even under favorable conditions, it could take 5 to 7 years for output to approach pre-crisis levels. But even incremental increases matter in a market where demand growth is flattening. This is where Venezuela's return intersects with a larger structural shift. Global oil consumption is no longer on an unchallenged upward trajectory. Electrification of transport, efficiency gains, and climate policy are reshaping demand expectations. Investors increasingly view long-term oil projects through the lens of risk. Will demand still exist when these barrels finally come online? In that context, Venezuela's vast reserves, once seen as an unmatched advantage, become a double-edged sword. They promise abundance in a world that may need less oil, not more. If multiple producers expand simultaneously, prices could remain depressed for years, squeezing budgets and accelerating consolidation within the industry. For OPEC, this scenario threatens relevance. Managing scarcity is easier than managing abundance. Persistent oversupply undermines the cartel's ability to influence prices and could intensify competition among members. For high-cost producers, sustained low prices could force painful adjustments. For consumers, the picture is more favorable. Lower and more stable energy prices reduce inflationary pressure and support economic recovery. But cheap oil can also slow investment in renewable energy, complicating climate goals. Policymakers will face trade-offs between affordability and sustainability. Venezuela itself sits at the center of this contradiction. Reviving oil could provide desperately needed revenue and social stability, but over-reliance on hydrocarbons risks repeating past mistakes in a world that is moving on. The challenge will be to use oil not as an end, but as a bridge, funding diversification rather than delaying it. The arrest of Maduro is therefore not just a political turning point. It is a moment that forces markets, governments, and citizens to confront an uncomfortable question. What happens when one of the world's largest oil reserves re-enters a market that no longer needs it as much as it once did? The answer will shape prices, policies, and power for years to come. What this moment means. The arrest of Nicolás Maduro did not shake oil markets because the world has changed, but Venezuela still matters, not for what it is today, but for what it could become. This moment sits at the intersection of geopolitics, energy abundance, and human recovery. Whether Venezuela's oil becomes a force for stability or another chapter of lost opportunity will depend on governance, transparency, and global restraint. For markets, the risk is not scarcity, but oversupply. For Venezuelans, the stakes are far more personal. As this story continues to unfold, one question remains open. Will this historic rupture finally lead to renewal or simply rearrange the balance of power? Share your thoughts and perspectives.